In this video, I'm going to show you how to retire making $10,000 per month using the simple 1-1-2 strategy. I've done this for myself. Some months I've made $10,000 a month. Some months I've done worse, and my average return was about $5,000 per month. But not only that, I've helped others do this as well, and I've helped hundreds of others make as much as $1,000 to $2,000 per month using this same strategy. So let's dive into what you'll be learning in this video. Quite simple. You'll learn a quick summary of what options are if you're new to that. You'll learn specifically what the 1-1-2 option strategy is. You'll learn the back test. You'll see how it performs over time. You'll see how to trade it on a chart. We'll pull up a chart and I'll show you how to break it down. I'll show you how to enter it in the broker so that by the time you get done with this video, you can actually implement it yourself. And I'll show you how to manage risk that comes with this. Then I'll show you how to scale your trading account based on how much money you have in it. And then I'll show you how to actually automate the entire strategy. So let's start off with part number one. What are options? So face smaller and let's dive in. This should be a quick recap for those who don't know, and then we'll get into the fun stuff. Okay. There are a bunch of different things that we can do with options. Options are essentially betting on a stock. So just like when you're betting on a football game, where you say, hey, I bet this guy can run a certain number of yards, or I bet this golf player can hit a hole in one, whatever it is, you're betting on something underlying. And the same thing happens with options. We're betting on where a stock will move. So let's say a stock is trading like this, and we think the stock will continue higher. Well, then we can bet on this level down here and say, hey, I bet the stock will stay above this level. And if it does, I make money. So that means if the stock goes up, I make money. If the stock goes sideways, I make money. If the stock goes down, but stays above my level, I make money. And this is what essentially selling puts are, is we're betting that a stock will stay above a certain level. If it does, we make money. If it doesn't, we lose. And that's the basis of a 1-1-2. A 1-1-2 bets that the stock will stay above a certain level. This level we do here is about 10 to 20% away from where the stock is. And we also have a hedge. In case the market comes down, we'll have a hedge to trade with. So let's dive into the next part of this lesson, which what exactly is the 1-1-2 option strategy. So the 1-1-2 is this, okay? It's structured like this. We buy one put contract. I'll explain all this more in a second here. We sell one put contract, and then we sell two put contract. This is where the 1-1-2 comes from. Just looking at the quantity of these contracts, we have a 1, and then we have a 2. So when we structure this trade, this is what happens here. Let's say this is the stock, right? It's trending up, which is good. And then we have a profit graph like this. So you can see here, it looks like this, like this, like this, and it looks like this. So what does this show us? This shows us our profit graph. So profit is going to be anything right of this line, and losses will be anything left of this line. So if the market goes up, we're going to make this amount of profit, which in these trades equates to about $1,000. Now, if the market stays neutral, we're still going to be inside this profit zone, which is going to make us about $1,000. So this is awesome. This means if the market goes up, we'll make $1,000. If the market stays sideways, stays flat, we'll make $1,000. If the market goes down and goes inside this level, then we get about a 3x payoff. So we'll make about $3,000 instead of $1,000. So just like this, $3,000 we get to make if the market goes down. And if the market drops 10 to 20% down here, then we're in this zone, which is going to be, depending on our stop loss, about a $4,000 loss. And I'll show you here in a second. So this is why this trade is so great, okay? Because down here is like a 20% down move, which almost never happens. So what we see here is if the market goes up, we make $1,000. If the market goes sideways, we make $1,000. If the market goes down, which is a downtrend, but we don't drop like a super fast crash, we make $3,000. And if we lose $4,000. Yes, this is a large loss, but compared to the amount of money that we make when we profit, it really plays out and does well. Now to prove this, here's a backtest I have from Option Omega. Again, I'm doing this on SPY. We typically do a 1-1-2 trade on options futures because it gives us the buying power requirements that we want, but I'll break that down here in a second. So again, SPY, if we look at the return, we just simply want to multiply this by 10. You can see here, it shows you our win rates, our drawdowns, and all those things. So you can see here, if we're getting about a 7% return, then again, if we multiply that by 10, then on an average year, we can make about a 60 to 70% return, which actually a lot of people aren't able to do when they properly trade these. Again, you need to manage risk, which I'll be talking about later. So you can see here, a very consistent strategy does have some risk. We'll be discussing how to mitigate those times. But just like this, over this period of about, I don't know, when we start here, about 2015, 2014, 13, okay, cool. It made $1 million in 2000, $1,200,000 for 1.2 million. From this with an 86% win rate. So this is the strategy. It's consistent. It works more times than not. And so let me show you exactly how to break it down on a chart. So we've covered the basics here of the 112. We've covered the back test. Now let's look at it on a chart and what we do with it on a chart. So again, I should have had this pulled up, but I didn't. So let's jump over to TradingView real fast. TradingView is a charting platform that we can use. And I'll go to ES, being the ES futures. Again, the 112 is done on a futures account. That's where it works best. Sweet. So from here, what we're going to do is I'm just going to show you another breakdown. Again, if the market is trending, actually, let's first talk about that. This strategy works best when the market is trending up. So again, if the market is bullish, sideways, so that means we're staying between major support and a major resistance, vice versa. And we also have a slow downtrend. So slow downtrend. This is when this strategy works best. And so if it's working best in this is when we want to trade it. So we're looking at it from a charting perspective. We want to trade it when it's within a trending channel. So if we look at this on a daily chart, you can see here that we're staying within this trending channel and we're moving higher. This is a great time to trade 112s, okay? This is where they succeed and do well. This is also a slow downtrend right here. You can see here how we're slowly moving down, nothing crazy, slow and steady. This is also a great time to trade it because then we tend to get, as mentioned before, as you can see here, we get that 3x payoff, right? When it comes into what's known as the bear trap, which I'll show you more about here in a second, but we get a higher payout when it slowly goes down. And so during this type of period, we can get that type of payoff. Now, where we do bad in this is right here for like 2020. COVID crash right here, these strong crashes, this strong crash. Again, when we drop super quickly, that is where you're going to run into your issues. But if we have a slow uptrend, slow down trend, neutral market, we're going to do great for this strategy, as can be saw on the back test. These drops are like 2020, 2018, things like that. So that's what we're looking at. Now let's dive into the next part. Now that you kind of seen it on the chart and the best type of markets to trade it in, is my favorite part is how do we actually enter this trade on the broker and what type of credit are we looking for? So if we come here to the broker, you can see here using these types of strategy, I'm at $531 today. So that's nice. But again, we're going to go to ES is what I'm going to show it on. Again, when we talk more about account sizing in a second, I'll tell you what assets you can do it on based on your account size. But if we're starting here, the 112 is really structured in a very certain way. And so again, if you want to take notes on this, you can, but this is how the 112 is ideally structured. Now I structure it. Again, you do a 90 to 120 DTE trade. Now, why is this? This is quite simply because the further out in time you go, the more credit, aka the more profit you make, and the higher your win rate, and the less the volatility risk. So overall, when you go further out, you really increase your win rate, you increase how much money you make, and you limit risk. And so that's why we go out further out. Now, the downside is we have to wait longer for trades to play out. It takes longer for trades to hit their profit target, but we get so many benefits from doing this. And that's why it's preferred to do these long-term things. I personally go either 90 or 120 DTE or a mix of both. So this is the contracts we're looking at. Now, like I mentioned, we're buying a put, we're selling one put, and then we're selling two puts. And so for these levels, what we're doing here is we're doing a 25 delta. So 25 delta, then we're doing a 23 delta, and then here I do a 7 delta. Again, people typically on average do between 5 and 7. I like to do 7 because it boosts up my returns. If I want to be more safe, if I want to have a higher win rate instead of collecting more, then I'll go more of the 5 delta side, but I like the 7 delta since it kind of boosts up my profit potential here. So this is how we structure the 112. And now how we manage this trade, because this is how we enter the trade. How we manage it is it's managed based on a 90% take profit. And we close the trade at a 300% loss. And that's 300% loss. And then a take profit. And then again, we can turn these trades into hedges, which is more advanced, but I'll show you briefly at the end of this. Sweet. That's how we manage it. So if we're going to the broker, we're going to look for these exact metrics, okay? So we're going to look for 90 to 120 DTE. So we have 92, 108, 122. I'll pick 122 for this example. Then we're going to look at delta. So make sure you're on the right side of this options chain and you click and make sure the broker shows delta. If it does, you'll come in here and you'll make sure that you select 25, 23 or the closest to it. So right here, we'll buy the 25 delta, or sell the 23 delta. And then on 7, we ideally look for 7 with the most volume. So this one has the most volume at 7. I'll click on this and I'll actually see if I can double click it and increase the quantity to 2. Perfect. Now I have the one that I'm buying right here, the one that I'm selling, and 2 that I'm selling right here. And so if we're looking at this, probability of profit, 97%. That's literally insane. I'm going to make I have a 97% chance of making money on this trade. Awesome. Now, this is where we see 2 different numbers. We have a max profit and we have EXT, which is the extrinsic value of the credit that we're receiving. Okay. And so our profit breaks down to this. We see 2,600. This is the small zone of profit that I showed you, where if the market goes up, we stay in that zone. So this is 2,600. And if we hit the bear trap where we have our max profit zone, we'll make 5,000. So if you come back to this example, you can see here for this exact trade we set up, this zone right here, instead of 1,000, we'll make about 2,600. So this zone here is 2,600. This zone right here is 5,000. So it's about a 2x payoff on this one. And again, if we're doing a 300% stop loss, it's 300% on this. So this zone of loss is going to be minus this times 3. So it's going to be roughly, $7,000 of a loss. So you can see right here, we have plus 2,600, plus 5,000, or minus 7,000. And so now you might be saying, Austin, that's a lot of risk. Yeah, we can change that based on what asset we're trading, but we'll talk about that in account sizing, so don't worry. I just want to show you how to structure this trade. This is how it's structured. This is what it looks like. Ideally, you'll be collecting, again, target credit. So if we're looking at where to target, so your target, I'm terrible at drawing on this, but target credit, the premium that you're looking to receive is going to be between $30 and $40. If volatility is higher, you'll collect more. Obviously, if you can collect more, the better. But typically $30 to $40 is where you'll see most of the times you're collecting credit. If we look at this specific example, we're collecting $51, which is more than usual. So 51 is a great trade. So now you know that I'm actually gonna make some good money. You see that ID rank is a bit higher, meaning that volatility is higher, which is why I have this higher premium. Anyways, more premium here means more profit that I can collect. Awesome. So what do we do after we hit the take profit target, right? This is the trade. Let's say the trade's running. What do we do after this trade has been running and we hit a 90% take profit? Like we see the trade is at a 90% return. Well, what we do is we can do a lot of things. There's a lot of ways to hedge this trade. And so here are 3 ways to exit the trade correctly. And so number 1 is simple. So there's 3 ways. Number 1 is we just close the entire trade. So at the 90% take profit, we'll just close out the entire trade, meaning we'll close the long put, we'll close the short put, and we'll close the 2 short puts. This is the simplest way to manage it, but it provides no downside protection. So this will lock in kind of the most profit because we take all our profit and we actually get to realize that profit. Then we have 2 is that we can turn it into a put debit spread. So if you see here, we have +1, -1, -2. Well, if we get rid of the -2 here that we sell, so if we buy back these 2 puts, we're then left with a PDS, or a put debit spread. And so if we're left with a put debit spread, this gives us, again, if we're trading on ES, like the example I just showed you, this will give us about $3,000 of downside protection. So this means if the market were to crash, I'm able to then have $3,000 of protection that it will get me. So the market will crash and this trade will make about $3,000. So this is great. Why? Because we took off profit from this trade, we made money on the trade, and now we're left with a bit of a hedge. Now, we do have to give up a little bit of that profit to keep this hedge on, but still, we make a profit, and now we have a hedge to protect our other trades, which works great. This is one of the benefits of the 112 is that it can be turned into these hedges. And last but not least, we have a ratio hedge that can be done with it. And so this one is done by having, we have 112 here, by closing the middle one. And so we have a +1 and a -2 left here. So +1, -2 creates a ratio hedge. And this gives us a lot of downside protection, as much as $20,000 of downside protection. But but it takes up most of your profit. And so what you typically do is when you're trading this, you're putting on a trade every single week. So you could have like 5 trades open, right? And so with one of those trades, when you close the first trade, you'll turn it into a ratio hedge to give you a lot of downside protection. And the rest of them, you'll either close out fully or you'll turn into a put debit spread hedge. So this way you can have $20,000 of downside protection to protect your other trades. Like I mentioned, you can have a lot of loss when this trade goes against you. But now we have a hedge that will actually increase in value as the hedge goes down. These are what you can do by turning the current trade, by closing certain parts of it to turn it into a hedge. But again, you're always welcome. See, your fourth option is to just buy a put, a 30 DTE or whatever, put 30 DTE to 14 DTE put. And this will also provide you downside protection as well. All right. So that is how we kind of look at it. Again, I know I just kind of covered risk, but how do we manage risk? And so the biggest way we do that is by turning our trade into hedges. And another big way is to trade with no more than 30% of our account. Futures options have a lot of risk because we're using a lot of buying power. And so when we do it that way, we don't want to exceed more than 30%. So if we have a $100,000 account, you want to make sure that you have no more than 30K in active trades. So if each trade, again, if we go back to the thing, you can see here, this trade costs us about $8,000. So let's use $8,000 for easy numbers. So if we have a $100,000 account, we should be using no more than 30K. So if we divide this by how much it costs to put on one trade, we then get a roughly 4, I think. Is it 5? It's 4. So we'll get 4 trades that we can have on at a single time. So that means I can have the 4 trades. So that's kind of what we're looking at. That's how you determine your size. So now that we're kind of getting into that next section, let's look at that right. But again, we're going to be looking at how to scale your trading account in size. So we were just looking at ES, which takes a lot of money. It takes $8,000, which is great for larger accounts. So if your account is $50,000 plus, you should be okay with it. Ideally more than 100,000 to be running these ES ones. So ES, if you're trading ES futures, again, you're looking for 50K plus for your account size. And then again, depending on how much you have, you'll be able to, 2 to 10 trades if you really have a large account, right? Now, a way to do this, if you want to do the same trade, you can do it on MES. And so MES is the micro ES. And so it takes about $1,000 to place this trade. So about $1,000 to put on one trade, which means that if you have a 5,000 count or more, then you can do this. Ideally, you want more than 5,000, but I've seen people do it with around 5,000 and do fine. And that means, 1 to 4 trades kind of. After you reach the point of 4 or 5 trades, then you probably want to scale up and do ES instead. But so ES for larger accounts, MES for smaller accounts. Ideally, you can go up to $100,000 in actively trading ES before you need to diversify. And if you're looking to diversify, the 112 strategy is still an amazing strategy. But now we can just diversify it across different asset classes by doing it on something like crude oil or gold. And so crude oil and gold are 2 options that I've used in the past. I just look for the ones that have the highest IV rank. So the ones that have the highest volatility rank, because that means I'll collect the most credit for those trades. So whichever one has the most credit, I'll switch back and forth and do 112s on either CL or GC. And this is after I have a significant amount of my account already in ES. So again, whether you have $5,000, $100,000, $500,000, $1 million in your account, you can run this strategy. Just pick the asset that best works for it, and make sure to keep in mind 30% of your account should never be more than allocated to a single strategy. All right, so that's everything about the 112 that I have for you right now. But now I want to show you the fun part is, yes, this strategy helps you create monthly income. It tends to be very consistent, especially when you hedge your trades correctly. But again, there's automation tools that we can now use to actually automate the strategy. So now we can get the income and get our free time back as well, instead of having to manage these trades yourself. And one of my favorite platforms right here is the Options Auto Trader. And so let me show you how simple it is. So I'm going to click on Create an Auto Trader. It's super simple. I just click Create, and then I plug in all the details that I just discussed. So I'll say, okay, I want to do a 112 strategy. So I'll click 112. I pick the symbol I want to do it on. Like I said, we have ES and MES futures here. And so again, if you're wondering how does this trade, well, it connects to your broker account. So for instance, you connect to your broker, you can connect, Tasty Trade, Thinkorswim, Trade, your TradeStation, all those, you connect your broker, and the system will automate the trades based on your rules. So creating these rules here, let's do the 112. And if you have a smaller account, do MES, a larger account, do ES. So let's do ES for the example. Next, like I mentioned, we like to target 90 to 120 DTE. So I'll just put 100 here, and that will find the closest one to 100 DTE. You can see here it's structured already with the 25 delta that I'm buying, the 23 delta that I'm selling, and it says 5 delta that I'm selling too, but I like to do 7 delta to increase my return a bit. I'll save and continue. Then from here, I say how often I want to enter the trade. This again is depending on my account size and how much funds I can do. So for now, I'll just say once a week that I enter this trade. Next, I can do my take profit percentage of 90%, my stop loss of 300%, and then I can turn this into a hedge. So this will, at the take profit, actually turn my trade into a hedge for me automatically, so I don't need to handle that. So I can close the entire position. I can turn it into a put debit spread hedge, or I can turn it into a ratio hedge. So put debit spread is pretty standard right here, and so that's kind of how I can structure that. So automatically turn it into a hedge at my take profit. And it says here each trade takes about $8,000. So how much money do you want this bot to use? So again, let's say, like I mentioned, I have a $100,000 account, and that means I should allocate about $30,000 to this bot, 30% of my account, right? And then also here on the safeguards, I know that I should have no more than 4 positions. So I'll put 4 there, which means that I'll cap out at 4 position. I'll save and continue that. And just like that, I've created a 112 bot. You can see here the buying power, rough return, risk per trade, depending on certain metrics. And then just like that, you can see the settings. You can save and authorize, and just like that, now that 112 bot has been created. It'll run for you. It will generate profit, manage your trades, and do everything about the 112 for you. And guess what? If you don't want to put in all those numbers, you can literally just click pick an auto trader. Go to our retirement income bots right here. These strategy examples, and the long-term 112 is right here. So you can just click start using this bot, and it preloads all the settings for you. You just tell it how much money you want to use. And just like that, you're good to go. So that's how simple it is to automate the entire strategy. And that's exactly how I do it to make about $5,000 to $10,000 a month on Autopilot. So that's how you can retire making $10,000 a month. Again, that's how you scale your trading. That's how you do the trading. And this is the exact strategy, one of the best ones around. And I recommend that you look into it, do it yourself, do some paper trading and explore it further. If you want to automate your trading, whether it's the 112 or a different strategy, click the button down below to start your free trial. All right, guys, see you later.